Today's merger is certainly helping to fuel the record rally, but could the euphoria be a sign of a top? Our next guest doesn't think so. He's bullish on the market, saying despite the risk factors like trade and the election, investors must, underline, bold-faced, stay in the market, or they will miss the next leg of the rally. John Koudounis is CEO of the Calamos investment group, where he has $25 billion in assets under management. Congratulations on a good run. John was ringing the bell today or something? Was that right?
Tomorrow we'll be ringing a bell for one of our seventh closed-end funds.
Oh, that's fantastic. Well, let's talk about the market and why you think it can go higher from these highs.
Well, if you look at the economy is really strong. We just had a very strong earnings season. We're looking at the consumer. Their balance sheets are very strong. We're looking at controlled unemployment, with controlled inflation, which is around 2%, and unemployment's all-time lows. So I think that it's very, very strong going forward. Now there are some headwinds, trade talks, the elections.
Should we be surprised that a lot of deal making has come out of the woodworks here lately?
There's a lot of money in the sidelines.
Yeah,
and there's a global thirst for yield. And so you're going to see consolidation in this part of the economic cycle. There's no surprises here. There's going to be a lot of deals. And it doesn't mean it's...
What's the danger that the buyers are buying at the top?
Well, the question is, when is it going to end? And everybody's talking, okay, it's a 10-year run. Is it going to end? And the past doesn't necessarily predict the future and the length of how long this can go, because it can go for a long time. Even though it might be at the end of the cycle, that doesn't mean it's over. We can go another year, 2, 3. Now, event risk, the elections, everything else, will have a huge part to play in it. But the economy is still strong. We see deals continuing to happen. I think we'll see even more M&A deals in the next few future.
Why do you think deals are necessarily a sign that the markets can go higher? I mean, it sounds almost like companies, they're not spending on CapEx on their own. They're not building out new factories, which we've seen in the data. And so therefore, they're looking to make some deals to save on costs, to get efficiencies up. I mean, that doesn't sound like a position of strength here.
Well, it is. They're looking for growth in any way they can get it. So a lot of companies have exhausted growth internally. So they need to add to, and that's why we're seeing a lot of consolidation. So growth is a main part. Yield, searching for ways to make money. So a lot of the firms have already gone through cuts, who have already gone through that. Now they're looking, okay, let's consolidate, let's bring more growth, and then look for other ways to save money.
Consolidate means cuts. You uttered the word. We've seen cuts at WeWork are coming. I can't imagine that the Schwab TD Ameritrade is going to add employees to their workforces. Could these very deals undercut one of the legs of your thesis, which is that unemployment is low? Or are these deals in and of themselves really so marginal in a 300 million person plus economy that they don't matter?
Well, A, I think they are somewhat marginal. B, unemployment and employment is being redefined every day. Different types of jobs are being created that they weren't created in the past. Some jobs are being eliminated, but there's other jobs that are being created because of how the economy is changing, because of technology and things like this. So I think that overall it's healthy for the economy, and we're very positive. We think you need to be invested to take advantage of these.
So let's get back to the introductory sentence. You don't want to miss out on the next leg of this rally.
Sure.
What kind of leg are we talking about, in your view?
There's going to be volatility. We've seen that in the last couple of years. The administration, the tweets, everything else, the market's going up and down. Now, if you're not invested, unfortunately, a lot of people that try to pick the market, they get the lows and they don't get the ups. And so you have to be in it. You have to be in risk-managed securities in order to try to take advantage of when the market goes up and limit your downside.
John, thank you very much. John Koudounis of the Calamos Funds. Appreciate it.
Thank you.
Thank you.